All right, guys, we got a good one for you today. I thought we want to do something very timely since interest rates are changing all the time. We have with us Kenny Cutler with the JLL Capital Markets. He's based out of Miami. And the reason I want to bring Kenny in is several reasons. Number one, as a multifamily broker, obviously I've worked with lots of lenders in the past. And a lot of these guys know their stuff, as they should, especially as the asset gets larger. They're better and better at what's out there. They have access to lots of different sources. But what I really love about Kenny is he always answers the call. He always replies to your email immediately. He always texts you back. He's just Johnny on the spot, and I really appreciate that. And I know you as the investor does. And so what we're going to talk about today is lending rates for lease up, for stabilized, for value add. And please understand that we're filming this on October 3rd. Things can change a couple days from now. So if you're watching this 4 or 5 days from now and you want to have other questions, give Kenny a call. We're going to have him announce wherever you can find him at the end of the video. We'll also have a link down in the description as well. So Kenny, thank you so much for being on with us, man. And tell us a little bit about yourself real quick, and then we'll jump right into it.
Thanks, Beau. Yeah, absolutely. I do everything multi-housing finance, everything from stabilized to bridge deals to even construction financing, debt, equity, everything up the stack. You need something for your multifamily needs, I'm here to help. Conventionally working with institutional quality product, generally just larger deals.
Awesome. Thanks for being on this, man. We're going to jump right into this. So give us your thoughts on terms and rates and what you're seeing for both conventional and student. And let's start with like lease up stuff.
Sure. So again, today is October 3rd, 2022. I anticipate everything to change by October 4th.
That's right.
What we're seeing is generally as interest rates have gone up, lots of things have happened, including less leverage, less lenders out there, and higher rates. So all of that translates to generally inferior terms to what we had perhaps, call it 6 to 8 months ago. Your lender universe for lease up deals consists primarily of banks. You have life insurance companies with transitioning type capital for, new, and that's usually for new product in primary markets conventionally. And then you have your debt funds. There is as well a Fannie Mae pre-stab prior to stabilization type product that I'll discuss in a little bit as well. But those are generally the types of lenders that you're going to see quoting deals, new product, lease up deals throughout Florida's major markets. These deals are usually shorter in term, right? They're a 3-1-1 or perhaps a 2-1-1. Okay. And that's to bridge the gap between, today, which is lower occupancy, lower NOI, to perhaps a year from now when you're fully stabilized, the rent roll has matured, concessions perhaps have burnt off, and you have a fully cash flowing stabilized deal. Let's talk about leverage first. All else equal, conventionally, banks are towards the lower end of the spectrum as it relates to spreads over SOFR, and these are mostly going to be floating rate deals over SOFR. Banks are going to be towards the lower end, usually, call it 50 to 60%-ish in there. And then your debt funds and your life insurance companies with debt fund kind of money are going to be today, things are shaking out. And again, they're sizing these loans off of certain metrics like your debt yield and your stabilized DSCR. But again, those are going to be maxing out today, usually 65 to 70%, and sometimes a little bit above that if you're buying a deal really well and it underwrites exceptionally. So spreads on the banking end are going to be towards the lower end of the range. Bank spreads can be all over the place, and we've seen banks bend over backwards for relationship borrowers. And so I sort of hesitate to even tell you what a bank might be, because for regulatory reasons and for other reasons, they can do wild things to win business. Right. We're still seeing exceptionally low spreads in some instances. And again, those are going to be over floating over SOFR. So I'm going to sort of bite my tongue on that, because on the low end, we see very low spreads. I can tell you on the debt fund side, spreads are going to start in the high 200s and probably go up 100 basis points or more from there for new products in the lease up. The last one I would mention is that Fannie Mae does have a pre-stab program, which is very strong. While you're under app, you are subject to market fluctuation. And that's a fixed rate product, by the way, and sort of functions similarly to, a conventional agency loan, except you don't have to be at full occupancy at the time of close. What you can do is they sort of triangulate the NOI based on historical leasing. And sort of all you need to do is be 75% occupied at the time of rate lock, and then using historical leasing data, basically prove out stabilization.
Like a trajectory of all the
exactly. That is a highly variable leverage point. I hesitate to say where that is shaking out today, but that's the meat of the market is debt debt fund, bank, and agency as well, actually, for lease up product.
Well, cool. So let's transition to the stabilized product.
Yeah.
Tell us what's going on there.
A lot of shakeup here as well as stabilized interest rates also move. So I'm going to talk about your lender universe, but really the meat of the market is the agencies year in and year out when they have number one market share every year for a reason, right? They have very, very attractive spreads. They are quoting in primary markets, secondary markets, tertiary markets. They're going to adjust your credit buckets for things like, the market you're located in, the product type, et cetera. But year in, year out, the vast majority, they have number one market share every year. So today they are, I would argue, the least conservative. They're probably the most bullish. And part of that is a result of allocations. They have lots of money to put out every year. And so in markets like North Central Florida, they are still very, very active and still at basically your minimum DSCR bucket, basically meaning you can go as high leverage as the agency can go in those markets. So typically a 125 DSCR is where you're going to find acquisition financings are sizing, and spreads ranging from 160s, 170s over the corresponding Treasury. So if you have a 10-year fixed rate loan, it'll be sized over the 10-year Treasury. And, you have a 7-year fixed rate loan, 7-year Treasury, et cetera, and spreads starting at 160s, 170s for more affordable product, creeping up to call it 200 over for more market rate stuff, and even higher, maybe even low 200s. And then you can talk student as well. For student, you're probably mid 200s. And I can sort of talk about how the agencies view student product. I would tell you they generally want to be at a Power 5 school, a big state school. They generally do it as, in the case of Fannie Mae, Tier 3 business, which means a higher DSCR, lower LTV. Fannie will only basically do it with existing student housing borrowers or folks with lots of student housing experience. Freddie might be a little bit more flexible, but still very selective, and typically want it for their best relationship borrowers. So much tougher to do that sort of stuff than conventional product. But again, they're usually the number one lender for that type of stuff as well. So that's your stabilized agency deals. We're seeing more folks borrowing from CMBS lenders. Right now, life insurance companies, which have been for new multifamily product, have historically put out lots of volume. We're seeing them be just less competitive just based on their spreads than the agencies, for example. Again, banks who are an amalgamation of lending programs, they can do some very, very attractive things for relationship borrowers.
And what about loan to values on the stabilized?
Yes. Again, highly variable in the agency stuff because they're solving using basically a formula on DSCR. For acquisition financings on those, we're seeing 55 to 60%. And then on banks, maybe 50 to 65%. Again, that's a wide range. It's very, very variable these days. It just depends on the performance of the asset and sort of where NOI is shaking out, historical property performance, where the Treasury is on any given day. Again, Treasury rates they come in, they come out.
What would you put those stabilized loan to values at the beginning of the year as a comparison? Maybe 75%?
Maybe not that high. Acquisition deals, when folks are buying deals and you're buying a low cap rate deal and you're sizing a loan based on in-place NOI, you're still not getting that high in leverage. If you're buying a deal at a 3.5 cap, as a lot of folks were at the beginning of the year, or some cases, if they're just underperforming assets, even lower, right? And you're sizing off a DSCR, which is using that NOI to come up with a proceeds figure, chances are it was much lower, actually. I think as cap rates actually creep up, we're going to see perhaps that gap dissipate a little bit, perhaps about the same or even inside.
So let's talk about value add then. Is there still a market there?
It's definitely still there. I would say there is much less availability of capital than there was at the beginning of the year. That might be true across every deal type. Value add is going to still be your banks and your debt funds. I mean, those are going to be sort of the meat of the market as it relates to North Central Florida value add. But you can get higher in leverage, again, probably 60 to 70%, probably the same type leverage, 65, 70%. Again, if the deal size is exceptionally well and it's the perfect deal, probably closer to 70. Spreads there starting at the high 300s and going up from there.
What about any interest only periods?
Those will be full term IO, but these are shorter term loans, a 311 or maybe even a 211 type deal just to get you through your business plan. If your business plan is to go in, renovate every unit and then stabilize, and that takes you 18 months, then you're probably going to see perhaps a 2-year term with extension options,
Gotcha.
or maybe 3 if you need to do a pretty heavy turn of the rent roll.
And then, so value add student, that'd be the same thing, sort of lower loan to values, higher rates.
Yep. All else equal, it's just going to be inferior lending terms.
Yeah.
They're going to have higher spreads. They're going to be lower on leverage. All else equal to this institutional community. It's just sort of a less favored asset class. It's a subclass to multifamily. And due to risk factor, it is just less desirable. So you just have higher cap rates. You've got higher interest rates. You've got lower leverage, less IO, et cetera.
So question for you. This is just Beau talking to Kenny, who's not with JLL, and he's just his own guy speaking on his own behalf. In my mind, I see interest rates adjusting downward, not necessarily 3%ers again, right? Later 2023, start of 2024. And the only reason I say that is, in my mind, I think election year, I think Democrats and Republicans want to sort of show good face. And that's usually one of the things that happens. And so I just want to get your take.
I hate to speculate like I have a crystal ball, but I'll tell you what
I gave us all the protections. We're protected.
Yeah. I'll tell you what some of our borrowers are telling us, and that actually offers lots of perspectives. There are folks who think interest rates are going to keep climbing, and so they're locking in fixed rate financing now, long-term fixed rate financing, even at 5.5 and even higher in the case of student or other type financings. They still think it's going to be attractive relative to the long term. And then you have other borrowers who say, you know what, I actually think that the Fed is cooling things down now. They're going to continue to increase the Fed funds rate. But in 2 years, I think that, for example, the Fed funds rate will need to come down actually. And with that comes SOFR. And so I'm actually going to put floating rate loan on my deal because I want the flexibility of being able to prepay my loan instead of having onerous prepayment penalties. Maybe I'm going to sell in 2 years. I have no idea. I'm going to put floating rate money on this and take the risk, take the market risk, because I actually think things are going to have to speed up in 2 years from now. So yeah, I've seen both sides. We have borrowers who take both sets of views. I'm not going to tell you which one is right. Which do I think? Man, I think I have no idea. And in the short term, I think in the short term, call it the next 3 years, rates are going to continue to climb. There will always be folks who need to sell and folks who need to buy, and there will be people meeting the market. Just high level on the student housing market a little bit I wanted to touch on. So look, every lender profile has raised their cover metrics, and I think that's also applicable to the conventional space. As rates have gone up, your DSCRs go up, so there's just less leverage availability and more cash equity going into deals. So there's been a pricing adjustment as a result of that of perhaps 8 to 15% in the student space, depending on factors like rent growth and the market you're in, et cetera. Exit cap underwriting has increased pretty drastically, especially in the conventional space. I think folks would tell you some of the hottest markets, it's probably gone up 75, 100 basis points or more. And expenses are also way up. I think people are still projecting rent growth, but expenses are expected to go up as a result of macro inflation and other factors. In the student housing space, every major player is pushing rents 10 to 14% over the next couple of years. So Blackstone just acquired ACC. They announced that they're going to push rents about 10% across their portfolio.
I'm seeing it already on pre-leasing for 23, 24, like incredible stuff. Yeah.
The way I think about that is, let's say you have this massive portfolio of student housing across the country. If in the Midwest, rents are going to go up 5, 7, 8%, that means in Florida's markets, in the Southeast and other markets, they're going to have to push rents much higher. That 10% is sort of just an average. And so I think your Power 5 schools and the schools like Florida, for example, are going to see even higher rent growth. Perhaps the most active lender on the student housing space is still your relationship and local regional banks. Again, they can do fantastic things for relationship borrowers, especially with substantial depository relationships. And look, there's a cap rate premium or rather a cap rate spread for student housing product. And so what that means is if you're buying a student housing deal at a stabilized 6.5 cap, you're out of that negative leverage territory much sooner. In other words, your interest rate, it could be 5.5, 6% fixed, but if you're buying at a 6.5 cap, that's positive leverage versus deals that have returns if your returns in place are lower than 5% and you're borrowing at 5.5% money, you're in that negative leverage territory. You're sort of avoiding that, or at a minimum, you're getting out of it faster with student product. The other thing I think we're seeing is that tier one schools, they start their pre-leasing earlier and earlier, it feels like.
It already started a month or two ago.
Exactly. That's just another mitigating factor. Another reason why people like student housing and multifamily in general is just you're getting new rents every year. And so you're hedging that inflation. Whereas with other property types, I think you're sort of locked into longer term leases. Even if they're net leases, you're locked in and no ability to push that rent until the lease rolls in 10 years or what have you.
Kenny, thanks, dude, so much for doing this. How can folks reach you?
Yeah, shoot me an email. My email address is kenny.cutler@am.jll.com, or you can call me at 305-978-6890.
Awesome. And I'll put that down in the description, and we'll definitely have to bring you back on, brother. Thanks for coming on, man.